Hi, and welcome everybody to the Capital Markets panel. We've got a great group here. I think we're in for a very interesting discussion. I'm really happy to introduce the moderator, Todd Rich, who's the co-founder and the head of real estate at Declaration Partners. Declaration was founded in 2017 with funding from Rubenstein, who we met or heard from earlier this morning from his family office. Todd will introduce the remaining members of the group and will be leading the discussion. Enjoy.
Great. Thank you, everybody. Hopefully you can hear me. If not, shouting or waving would work. Thanks, DLA. Thank you, Brian. Allison. I also want to thank Allison Mitchell and Lauren Rico from DLA who have helped us put together this panel of esteemed panelists. Really excited to talk about the capital markets, not because the capital markets are green and to the right, up and to the right, but because there's actually been, if you've noticed, a little bit of trepidation in the capital markets, a little bit of volatility over the past really 6 or 8 weeks. I think just by looking around and obviously our prep conversations, people on this table, or this little podium here, have experienced some capital market volatility before. We're not so new like the folks that Chris Merrill was talking about who have never experienced a downturn. We have experienced a downturn. We have experienced some of these, these changes, perhaps not in the same way, or certainly we've had 30 years of interest rate decline, now the other way, perhaps. So I think there's a lot to talk about, but I really want to get to the panel and talk to them. I'll let everybody do their own introductions, but just wanted to point out to this group how excited we are to have such a diverse set of viewpoints here, right? So we have a traditional private equity fund investor, real estate, obviously. We have an operator who's sort of vertically integrated. We have someone who has spent most of his time focusing on platform businesses, in particular in some of what used to be called niche sectors. Maybe they're now the main sectors in real estate. And then we have someone who actually started in the municipal bond world and has become a leading investment banker and investor. And what's neat is that everybody here, despite having slightly different perspectives to bear, is actually a principal investor. And I think that's really unique as we hear it. So I'm very excited to hear from the panel, but maybe I'll turn it over now to you so you can.
Thank you. Todd, that was very well put. Hopefully you can hear me. Okay.
Yes.
And thank you to DLA again. We appreciate your partnership over the past 12 years of Artemis's history. So I'm at Artemis Real Estate Partners. My name is Anar Chudgar. I'm a co-president at Artemis. We are the first majority women-owned real estate private equity firm in the country. We were co-founded in 2009 by Penny Pritzker and Debbie Harmon, who many of the people in the real estate industry do know. Today we're 70 people wide. We have about $8 billion under management, and we're a traditional real estate private equity firm where we have multiple funds, including a niche fund, a healthcare fund, focused fund, our traditional opportunistic value add fund, our core plus fund, and now our credit fund. So we are excited, and the only thing I would say is that we've been a diverse organization from day one and really believe in the diversity of thought and perspective.
Thanks, Todd. I'm Brian Kavusian. I'm the one of 5 managing partners of National Development, which is a regional firm, investment development and management. As Todd said, we are vertically integrated. We invest through a series of private equity funds. Our Fund 5, I think, thanks to the help of DLA, is closing today as I'm sitting on this podium. So thank you, DLA.
They work hard, so you don't have to.
Exactly, exactly. I got a partner in the audience that does the same thing. It works hard, so I don't have to. We have about $5 billion of gross assets under management, as I said, almost entirely focused in the Boston marketplace across product types, but single region, and are typically investing about $500 million a year gross into the Boston market across product types, which we can talk about later.
I'm David Lentz. I am CEO of Green Court Partners. We're a Chicago-based private equity firm. We're somewhat unique, I guess, in that we focus on building fully integrated operating businesses around niche real estate strategies. We're right now focused on airport parking, senior housing, and manufactured housing communities.
My name is Jim Reynolds. I'm also a client of DLA. It's kind of strange how everybody just coincidentally happens to do business with DLA. But DLA, actually, from the inception of our firm, DLA's been our partner back when it was really a small DLA. So, but I own an investment banking firm called Loop Capital Markets. one of the larger privately held investment banks, about 300 of us, a nice middle market investment bank. I actually come at this legitimately from the capital market side. I started out as a bond trader in municipal bonds, as you point out, in 1982. Remember, interest rates might have been a little bit higher, right around an 18% prime rate, which is when I started really trading bonds, and really kind of migrated into real estate investing, primarily because I did it so much on the financing side, either with municipal bonds, taxable bonds, or advised capital. So it's very interesting to marry the two and the three, really, because we also, Magic Johnson and myself, put together an infrastructure fund. And if some of you have flown into LaGuardia, the new part, that's Magic Johnson and my equity contribution to that. So.
I will just say, James, that living in New York for the past 18 years, that is a huge addition, and people don't even know where they are anymore. So that was
Thank
great.
you. Thank
It
you.
almost feels like a first world country.
100%. 100%.
Maybe why don't we use New York actually as a launching point? Obviously, we just heard from a panel who didn't really feel very bullish, I would say, about gateway cities, right? It seemed to me that there was very little investing in gateway cities. Each of us is from a gateway city, right? So I live in Washington, D.C., New York, Boston, and then two Chicagoans. So maybe we'll start there with a question about gateway versus not gateway, and maybe within each of the metro areas, there's obviously the city portion, but these are major metropolitan cities. They also have suburban areas as well. So maybe like your thoughts about urban versus suburban and gateway versus non-gateway.
Can we start? Sure.
Sure.
So I'm from Alabama, actually, which people don't know that.
My dad is from
But I
Alabama.
have been in New York for the past 18 years, so it's kind of a toss-up. What do I call home? I will say that the one thing in New York, which they didn't touch on earlier, is the residential market in New York is back full circle, back to pre-peak levels, back to even pre-pandemic 2000, even before the residential sector in New York was going through a bit of volatility, even prior to that. So the residential sector in New York City is fully back. The office sector is still, we're seeing occupancy back and actually seeing a tremendous amount of leasing done, but you're not seeing the actual occupancy in the buildings. So you're seeing the driver of growth, but you're not seeing the occupancy in the buildings. But all other sectors in New York are quite stable besides kind of the retail and office. I would say hospitality even is back. I think the challenge for us in New York, especially in the sectors where we think that we believe there's repricing. Oh, there's something going on.
We feel the same thing. This time I heard a sound before it started, so there must be some sort of a.
Is it a freight train?
It feels like it.
It's Chicago, so hopefully not Earth.
Right. Either it's me or this stage is shaking,
Yeah.
rocking quite
I
a
forgot
bit.
my Dramamine.
I think it's the words are so riveting.
Totally residential. And so I would say that I think the biggest issue in New York is we still haven't seen that repricing of the assets that have been impacted by the pandemic. And so while I do believe, I would say never bet against New York. So we're seeing life science, and we actually just looked at an opportunity this past week, with the conversion of office to life science in Manhattan. So I do see some of that conversion going on, but I would just say that we need a catalyst to kind of force repricing, and because the leverage fundamentals from the prior recession versus today and the repricing haven't caused or haven't enabled or catalyzed the repricing in the pandemic affected assets, that we're not seeing that volume yet.
And Brian, have you this office to lab or office to R&D conversion, has that happened at all in Boston?
A little bit. Just to put Boston in perspective, 10th largest metropolitan area in the country, I think 8th largest from a GDP standpoint. I think number 3 on AFIRE's list after Atlanta and Austin in terms of places where international investors want to invest in. If you're a core investor, we'd welcome you to Boston. If you're value added or opportunistic, you should stay in Chicago. But we can hit some of the segments here. Obviously, Boston's economy is driven by education and healthcare, and I think we still have the leading life science marketplace in the country. 19 of the 20 largest pharma companies are in Boston, as well as all of the biotech industry. That business has had an extraordinary run over the last several years. COVID supercharged it. The secular trends were there. COVID put even more capital into the business, both through venture as well as the government, and created a whole lot of more capital that needs to be invested, which of course it does in new companies. Demand doubled in terms of absorption last year from 2.5 million square feet to 4.5 million square feet. And importantly, not everybody could suddenly be in Kendall Square, which is the heart of it, and therefore began to consider a whole series of alternative locations, both in the city of Boston, competing with office tenants. Many office buildings that were going to be built as office buildings are being built instead as life science buildings because of the economics that are far more favorable, at least they have been. Conversions have been happening in the city and around the city and even out to the suburbs. I would say that is largely in response to not being able to create new product quickly enough. I don't think there's too many tenants that would choose to be in most converted office buildings into lab buildings, but there was a period of time in 21 and 22 where tenants literally had no choices. We had basically zero vacancy. Rents went up by 30% in the course of a couple of years, and so conversions became a real thing. Residential, like New York, Boston is back. Rents are probably 10% higher than they were in 2019, and rents are continuing to escalate. Office market, I think we're seeing the same trends that most other cities are. We're more occupied than San Francisco and New York, but we're nowhere near where Dallas and Austin are, and unclear when all of that happens. And clearly a movement towards new trophy at a 30 to 40% premium over A and A minus, and a real trend that's happening as we speak in Boston in a meaningful way.
I don't know if you do much gateway investing. I know Jim has a project that's sort of a large project in Chicago, but I'll hand it over to either one of you to talk about Chicago and how you feel about the city investing here.
I'll comment quickly on Chicago. We don't have any investments in Chicago, and I've lived here off and on for about not quite 20 years. And when I moved here in 2003, I just thought it was an amazing large city, and I love cities. Chicago was clean and safe, and it just felt like a great place to be. And it's obviously it's got most of what New York has from a scale perspective and density perspective, not all, but it's really easy to manage and get around. But what's changed in the last few years, and I think this is a combination of income divide and in some cases the after effects of the pandemic, is the crime throughout the city has really picked up, and it's just amazing. I mean, I know multiple people who have been near shootouts and seen shootouts in parts of the city where you would just have never thought something like that would happen.
Wow.
And
you just talking about Ken Griffin?
Carjackings, and it's really becoming a concern for people, and it's a topic of conversation for people, and I think eventually it's going to affect people's appetite for living here.
You know, for us, it's different because we don't take a macro view of New York or Chicago or LA or Boston or Philly or Dallas. We sort of get down to the micro aspects of a city where we do business. For instance, as we started off, I started off in the bond business as a bond trader, built an investment bank, started an infrastructure fund, and before getting involved with real estate per se, we probably do business in, let's call it, 70 cities in the United States. Maybe I've been to 100 cities in the United States. I've been to cities that people never even heard of or didn't know existed, because every city issues a municipal bond, virtually. That's how they finance themselves. The way we got into real estate was our clients, generally speaking, mayors, city councilmen, governors, county presidents knew us because we had raised their debt. We just did $1.5 billion deal for City of Chicago. So we're $1.5 billion deal. You do the deal, you hand $1.5 billion over to the city. They know who you are. And so they then begin to really sort of talk a little bit to you about what else can you do. Hey, Jim, we've got a block of land in this area of the city. or we'll hear from Oakland. We're doing a big project in Oakland, 120 acres. If you ever been to Oakland, it's the Coliseum site. It's where the Oakland A's play and where the Golden State Warriors used to play. They're both leaving. It's 120 acres of probably the best land in Northern California. The BART station, Metro station, the airport, et cetera. But we got a call from the city of Oakland to come in and take a look at their interest in that land. We're working with Scott Goodman. I saw Scott with the Michael Reese site. It's 48 acres on the lakefront in Chicago, undeveloped, empty. We get relationship with them in the city. As you know, we're doing the studios on the south side of Chicago, where we're going to build up to 20 sound stages on 79th Street in an area that most developers would say is undevelopable. So we are very, very situational in terms of how we look at it. So where we see things like, where there are things like crime, disenfranchisement, and marginal things that might turn off a lot of people, that really really gets our juices flowing because one, they kind of de-risk the project because there's usually some incentives there for you to come in. Two, the land is usually owned by the city or something, you can get it for cheap. Three, the labor, for instance, with our studios, we're actually going to recruit young people from the high schools down the block to come in and teach them how to. So we always have a hook and an angle on when we come in that sort of makes us agnostic to what the macro view is, like downtowns, and to what the deal economics are.
Why don't we use that as a jumping off point? I know we do want to get to interest rates in particular, but before then, a few of you have mentioned development, right? And I guess Jim, you mentioned development in areas that were previously undesirable. Brian, you mentioned development in Boston, a variety of sectors, and you did as well. Just what is the interplay between development and interest rates? What is the interplay between development and inflation? What is the interplay between development and government incentives or disincentives? I mean, just in New York, I guess, has a particular change coming up that I think is really impactful there. But I'd love to hear each of you and think about how you're thinking about development today.
I'll happy to start out. So, the roots of our company are in ground-up development. We love to go to closings where you actually have a building there. But
Theaters are nicer.
But increasingly, especially over the last 3 or 4 years, there was, in our view, not enough yield in the acquisition of existing assets. And we believe that through our development platform, that we are earning a premium of anywhere between 500 and 1,000 basis points on a leverage basis to develop real estate versus to buy existing real estate. What do these changes in the capital markets mean? If capital is repricing, what's the right development yield to build to? I mean, we were all pretty certain of that 3 months ago. We followed it down.
What was it 3 months ago?
Depends on the product type, but we were building, life science with Alexandria to, on paper, a 7+. They turned out to be higher because there was rent growth, but call it I can't take credit for the 8 or 9 that it ended up being, but 7. Housing in Boston is, under 5.
Wow.
Senior housing was on a stable, and I'm giving you untrended numbers, and seniors housing was 7 to 8. And I don't know what the right number is today. And the one challenge that I think we face is duration risk associated with development. Both in terms of what interest rates and capital costs are going to be when we get to the end. Construction costs, I think some of the things that we do can handle increases in construction costs, so that's not the first thing on my mind, and that's been on our mind for the last 1.5 years anyway, but I do worry about the duration risk associated with cost of capital. And in terms of how it relates to cities, as these cities become bluer, we're not exactly, the heroes in town, and we're really easy to beat up on. And you know, in Boston, there's talk of rent stabilization, and you know, it's getting tougher and tougher, which in some ways is a good thing. It's going to create scarcity. It's going to force rent growth, which can probably allow us to handle higher cost of capital and higher construction costs. So those are some of the things.
So when you say that's a good thing, what I just heard you say was I think it's actually going to be terrible for the residents that you think it's intended to help, because what's going to happen is there will be less supply and therefore more rent growth. Is that
I'm
was that an accurate?
I'm very
read?
worried about the almost certain rental rate growth that's going to happen in these cities as construction costs continue to rise, as our cost of capital continues to rise. The rents that we are going to need to get, the lack of new supply is going to force rents up, which is going to create even more political backlash. I think that's a real issue in many of our cities.
Anyone agree or disagree?
I mean, I definitely agree, and you know, we have seen it tenfold in New York, right? With the change in regulation on the affordable side, you're not incentivized to put capital into your building, which is a problem in a low inflation or in a low interest rate environment. When now we're in an inflationary environment, and we've been in an environment where there's been zero rental increases. Now, you know, the government is now saying, okay, now you can do 6%. Well, now we're in an inflationary environment where the average American household in that category, over 50% of their costs to date is in rent payments. So then you push that in an inflationary environment. I think we're in a tricky situation. So yeah, I would say that I agree, but I also think that there's a lot more ramifications that we're not thinking about, and I think it is a very complicated problem. And us as fiduciaries, we're not knowledgeable enough, so we're not going to plan that.
And then New York, the other point that I think some in this room probably know about is the expiration of the 421A law, right?
Right.
So starting, unless a developer has foundations in as of June 15th of this year, you know, they will no longer get the benefit of what's called the Affordable New York or old 421A benefit. That benefit was that if you added 25% of units as were affordable, you would then get a 38-year property tax abatement. Property taxes are relatively high in New York. That's a pretty good thing. Without it, there's a strong fear that development will stop, and that is in fact what happened about 5 years ago, the last time the law expired.
I was going to say, we're used to it because that expired 5 years ago, so you just automatically, when you're underwriting, you kind of just have to take it out. And so
what's the impact on rent rates? Are you assuming 8% rental rate growth like happened last time, or do you think it's going to be higher?
I mean, it's going to be hard, but I think what people aren't focusing on, which was I think a question you had, is the operating expense. Because I think people aren't focusing on the increase in OpEx. So everybody's just focusing on revenue growth because of inflation, and we're not necessarily taking into consideration OpEx.
What about in some of the other sectors?
Well, we don't do much greenfield development, but we've also, like Brian, we've found stabilized assets. We've found the yields to be too low and the pricing is just too dear. So we've kind of found a sweet spot with what I would call deeper value add projects. But the financing is becoming a real problem. You know, we'll take on floating rate debt for 5 years while we turn the project around. The things that we do tend to fill up more slowly. But the hedging costs have gotten so expensive, and then you've got this refinance risk 5 years out that in this rising rate environment is getting pretty daunting. So we're looking a lot more carefully at that, and even with residential assets that we finance through the agency, sometimes we'll price in a supplemental at year 5, and even that is gotten a lot more dodgy to price these days.
Are the agencies there? I mean, obviously the agencies have been driven by DSCR coverage, right? That's really been the thing. And so as cap rates have come ever lower, it's been harder and harder to find that the agency debt was the most attractive. I mean, what are you seeing now? I
mean, they're there. We're still getting agency debt on our deals, and they're still, we still think the supplementals will be there at a point, but it's definitely tighter than it was.
We're seeing it impact the proceeds, right? Yeah. And so, which is a great opportunity for us because we're pricing sub-debt, but the problem is inherently what
Meaning you're making loans.
We're making loans, yes, but I think the problem is also the DSCR coverage, right? And we're in an environment where half our team had never heard of negative leverage, right? And they talked about it earlier, and it's a true phenomenon, and you have to continue.
That is always good, is that it?
And half your team never heard of inflation.
Right, exactly. They haven't heard of inflation either. So I think it's something that we have to be very much cognizant of, and like everyone else on the panel, we're seeing yields that we're more favorable on development, but we're just very conscious of supply and demand, because I think But given industrial, everybody's like, if you just build industrial, it will come. But you really need to look at what the supply picture is and how commoditized your product is.
I think for us, we have a nice niche that we can do some big projects in and finance smaller projects too. Because we operate a lot in cities that are in urban areas, a lot of our projects are in opportunity zones, empowerment zones, where you actually get below market equity on some of these because of the incentives inherent in the financing structure. So we have a lot of high net worth clients that invest in some of the projects that we do. We also, but as you think about, to me, the question that you originally asked, the one that probably causes, the two that cause the most anguish really is inflation, because we've not seen, I mean, us old timers have seen inflation, rivaling these levels, but you've not seen 8-9% inflation rates, while at the same time being battled by the Fed to say, okay, how are they going to put this fire out, or are they going to make it worse? So you take this inflation where we look at it with our labor costs, particularly with labor costs and labor availability, but also the commodities cost that's alongside of that. And the debt that we do use, we're very fortunate when we have to get market rate debt, which we're doing a big project in New York on JFK. So we're doing the same thing to JFK Terminal 1 that we just did with LaGuardia.
Thank you.
Yeah, where do you, that terminal may be worse than, no, it wasn't worse than LaGuardia. It's pretty bad. But that's an $8 billion project, $2.5 billion of equity, a lot of debt. We just locked the banks in for the second time, 150 basis points higher than we thought we locked them in the first time, on about $6 billion of debt. And so we kind of go up and down the spectrum, but when we see some of the projects like we're doing in the city, like on the studios, we'll go through the bank's portfolios where they have CRA requirements, opportunity zone, emerging markets, credits, so that you could work your financing costs down, but you still have to work with the inflationary impacts on your commodity costs, your labor costs.
I would say we're much more focused on, I know that we are very focused on construction costs, and we're making sure that we, as a fiduciary, have the structure in place with our partners to make sure everyone's aligned. Because what we have been saved, even though we've seen construction costs go up over the past 18 months, we've been saved by the market. And so now we can't necessarily rely on that, and we have to ensure that we're being very focused on having the GMP in place, and before we invest, and really focus on our structuring and our governance and our underwriting, because otherwise it hits, we're IRR investors, so it hits us.
So look, we've been dancing around it, so let's get right to inflation and interest rates. And maybe, Jim, I'd like to hear your perspective. I work, as Brian mentioned earlier, with David Rubenstein. He likes to joke that one of his signature achievements when he worked in the Carter White House is that he got inflation as high as it's ever been. But we're close right now. Obviously, you've been a bond investor. There's probably no product in the world that is as sensitive to interest rate movements as bonds. The second might be real estate. So want to just hear your perspective. Are we getting back to those days of 18% munis, or what's going to happen?
When we had 18% munis, my hair was jet black and I could dunk a basketball backwards. Let's hope.
Now do you only dunk one way?
Yes, one way, standing on a ladder. I would say the odds of getting back to those days are not high, not likely. But the odds of where the Fed may end up and the damage that could be done, is very interesting to see as they try to catch up with maybe what they missed last time with 50 basis point, 50 basis point, 50 basis point, and what that means to the level of growth, which we're not seeing an awful lot right now. And whether we see a resulting stagflation or we figure out how to get this soft landing, which the Fed is aiming towards. It's going to be a tricky proposition. The good news is financing hasn't stopped. The market hasn't stopped because the adjustment is coming from, like right now as we speak, we just have a deal in the market today, a $300 million bond deal for Princeton University. If any Princeton folks,
That's my alma mater. So
Is it?
yeah, I hope that's cheap.
No, that's not the marching orders we got from the school. So we actually have to.
Is that why they called? They just asked for a donation. I don't know if that's related.
But so the deals get done, the oversubscription is there. One of the things we're seeing is we acquired in January a $6 billion money management firm that managed core fixed income that we wouldn't have even touched a year ago. As interest rates were zero, nobody was putting money into debt, into fixed income funds. Now, I was on another call this morning where we were talking to a $50 billion fund that said, Jim, we're going back to a 60-40 equity fixed income split, which, by the way, we were all raised on 60-40 equity to debt splits. We're starting to see an appetite and a resurgence of interest in fixed income investments that we really hadn't seen before, because you look at the last few years, folks were asking, why in the world would I own a bond at 50 basis points or 1% in 10 years when I can just buy stocks and get 20% growth, 15% growth, 10% growth? It's not till you hit a situation like we hit in January, really starting this year, till now, that you realize you can actually lose money in stocks. And the fact that you are in bonds and can be guaranteed to get your principal and an interest payment on top of that is really an attractive proposition after you've just lost 30% of your equity. And so there's some good forces supporting the debt markets, very good forces supporting the debt markets. That's not going to put us in a situation where we have to have interest rates like that in order to.
So what are these investors looking for? They're okay with 3% because it's better than losing money in the stock market, or do you think they're seeking higher rates? Do you think they're, I'm just trying to understand relative cost of capital.
So if you think about 3% right now, a year ago, at 3% right now, a year ago that was probably 75 basis points, 80 basis points, and they weren't buying it then.
And they were negative yields either way, right, on a real basis.
On a real basis, right. But there were negative absolute yields overseas in some of the European markets. They were selling bonds at negative interest rates. And so I think what bond investors now are coming back to the realization that a balanced approach makes a lot of sense. And we needed to get to this particular point to get folks back to the fact that you should never have 90% of your portfolio in certainly stocks and those tradable assets. And so now I think that we are at that point, and there is a really good floor to the debt capital markets right now.
So we, David Rubenstein and his family office we also have a 60-40 rule, but it's 60% private equity and 40% private real estate. Maybe just because you talked about the attractiveness of making debt investments, maybe Anar, you do both equity and debt investments. So maybe I'd like to understand just from you how you guys are thinking about that, and where in the capital stack. Is it core debt? Is it mezz, pref? I guess there are lots of ranges. But
we do everything, but we really look at it as what's the best risk reward for your dollar. So prior to the pandemic, when we looked at acquisition of multifamily, we couldn't make it work. So we would look at pref in multifamily acquisitions, and that actually worked out very well for us. One thing James talked about was that the investor approach to their portfolio, which has ripple effects across the board to us. So historically, everybody had huge fixed income allocations. Well, they were retreating that and putting it in a fixed income alternative, which was real estate. So now, be curious to see what happens to these bigger pension plans and et cetera, if they continue to do that. And now there's, as Chris mentioned earlier, the denominator effect of what's occurring in their equity portfolio now has led their real estate portfolio. So one of the biggest pensions in the country just told us that, yeah, historically they were significantly under their allocation for real estate. They're at allocation because of the equity portfolio. So I think that's something really to focus on. But within Artemis, we have one of our debt vehicle, our credit vehicle, is a core credit vehicle. It's 7 to 9% return in capital, and we're focused on whole loan originations and senior mezz. Now, the good news for us is it's a relatively new strategy. We've just spent $1 billion under management. It's really benefiting from what's occurring in the market, and we're able, our pricing now, we're 150 basis point wider than where we were. We're seeing proceeds come in, whether it's the government agencies or just banks. I mean, what has occurred over the past 2 months, we're seeing the banks have actually retraded, which hasn't happened. I was talking to an operator recently, a marquee New York operator, and he said, I haven't been retraded by a bank in over 12 years. And I just got retraded, and he got angry, and he said, okay, well, you can have the loan now. And which, even though our pricing wasn't as competitive, and because they retraded him, he was like, take the loan. So it's benefiting our business, so that's a good thing.
Better not retrade that guy.
We're not retrading him. we priced wide, so it was good. But as we think about where we, in the capital stack, it's asset class specific. Like in life sciences, we're a little bit more cautious on the growth in life sciences and how that's going to get absorbed based on the tenancy and the credit of the tenancy. Where's the tenancy? It's tech-enabled tenancy, and with the valuations in the tech market, it will impact those assets. So would rather take a equity approach, and so it's really asset class specific.
I think one thing people aren't talking as much about is that, for years, because interest rates have been so low, people have chased yield into real estate, and they've put on more risk than they might have historically wanted in a blended portfolio. And I think as rates come up, that a lot of capital is going to move back into more traditional debt instruments, and that may take some of the pressure off real estate pricing.
That's interesting. So given how hard it sounds like everyone feels like is, to make great returns, and it does sound like, that it's challenging. Maybe it's always been challenging. It certainly, during my career, it's always felt challenging. Looking forward, backward, less challenging somehow. But right now, I think we all agree it's challenging. And so, David, I just wanted to spend a little bit of time talking about your strategy, because I think what you do is that in addition to making direct property investments, you often make platform investments. Mm-hmm. Some would say that that's a structural way of trying to get alpha, but I don't know what you would say, so I'd like to ask, what would you say?
We've done it. We've done it both ways. We've built platforms and we've bought platforms and tried to improve them along the way. And so, it's pretty integral to our strategy overall to aggregate, and hopefully when we monetize, get a premium for the aggregation, but also to really improve operations. And that could be through technology in our parking business. We built a revenue control system from scratch that allowed us to introduce dynamic pricing to the airport parking business, which is something that had been happening in the travel business for years, in hotels and airlines for sure, and had not been done in airport parking. And that has made a huge difference in our business. And we're also, throughout each of our 3 current platforms, we're obsessed with the customer experience. We measure Net Promoter Scores. We get daily feedback, email feedback from all the people that fill out those surveys every day. In our parking business, we get hundreds a day because it's so many more transactions. We get dozens a day in the other businesses. And we learn so much about what we do operationally from that feedback. And it's literally a loop that's just constantly working back into our operational decisions and our processes, and it makes a huge difference for us.
Anyone else where operations is really important to the way that you invest or the way they think about it? Brian, you guys are vertically integrated, I imagine.
Well, I would say that, look, we've all had the wind at our back since I think Treasuries peaked at 16% in 1982. So we all think we're really great at what we do, but the fact of the matter is we've had a hell of a tailwind for a long time. We like to say that we're focused on creating value at the real estate level. We've obviously benefited enormously from cap rate compression, but I think this is going to make the ability to do things, create value at the property level, even more valuable. We are not going to have the Fed as our friend for quite a while. I don't know what happens to the 10-year Treasury, which is sort of the North Star for all of us, but clearly. We have got to find a way to continue to create value through development. We are in an operational business in seniors housing. We've developed a lot of senior housing around New England over the years. We're continuing to develop it. We continue to like the trends that were discussed on the previous panel. Obviously, inflation affects that at the operating expense level. Wages are rising at a very fast rate for the workers in those buildings. And the question is, can we, raise rents at a level that exceeds the rate that of wage increases? In some cases, yes. In some cases, no. But we think that being able to add real estate add value at the property level is going to be increasingly important as we go into this cycle.
And staffing is a factor there, just like it is probably for everybody's business in the room. And we have more turnover in our operating businesses than we've ever had. And what that means is people come in, And you've got a bigger percentage of your workforce at any given time that's not well trained and that's new and that's inexperienced, and so your customer experience suffers, and it's just, again, it's kind of a feedback loop.
It's
Challenge.
sorry, go ahead.
I was going to make a point around operating and the value add and actually staffing. So I'm from the south side of Chicago, from Inglewood, and when you see the things like we saw the other night in the city with a lot of kids coming downtown to the Bean and the kids getting shot and those sorts of things, I always think back to the root cause of these things. And coming from that neighborhood and now being a businessman and investor, one of the things we do, in addition to just investing capital in projects for a return, we actually try in our operating entities and even in our construction and building entities to bring value add to the community itself. And that's a very significant thing, particularly when you do business in cities with the city as your partner. And so as I mentioned, we're working with Farpoint on the Michael Reese site, 48 acres on the lakefront. That was city-owned land. They could have sold it to anybody, but they sold it to our team. A big part of what our team is going to do is, one, finance education of young people to learn the trades. So they're going to actually learn the trades, kids from around, and probably some of those kids that would come downtown and start trouble. And they're going to have jobs there. The small construction companies, minority and women-owned companies, are going to really be transformed by that investment that we're going to use to work with them. The large construction companies, I was on the board of the largest one, Power Construction, and I was talking to Rich Tucker about it. I went on that board at Power Construction because I was on the selection committee for the construction companies for the Obama Museum. And the president wanted something transformational, and he really wanted the construction to be led by minority-owned companies. And I was told that you absolutely wouldn't do it. You couldn't do it. And so if you really want me to do something, just say, Jim, you can't do it. Then it's undoubtedly going to happen. And so we wound up getting minority construction companies as the majority to do that. Though that building is a $600 or $700 million building, the largest one done. So when you think about the nature of some of our projects, and even in our studios, as we built those studios, we're linking up with my old high school, Chicago Vocational High School over there, as a vocational program. There is a shortage of studio workers, people to work, just like a shortage of all workers. So we're training folks in the high school to work behind the camera in the studios to be part of the crew. So when we think about operating, and we're doing the same thing at JFK. In Queens, which is where JFK is, $8 billion project, we're going to basically create JFK University for all the folks in Queens that want to come and learn how to work at the airport. So there's different ways, non-traditional ways, that you start thinking about, how you operate your company, how you do business in the cities, and ways that you actually can do good, build great businesses, and have great outcomes all the way around.
You were going to say something.
Yeah, I can't follow that.
Yeah, right.
So,
Well, then maybe I'll use that as a launching point to another area. So there's been quite a lot of capital chasing certain niche sectors, right, as we've used the word. Studios is one area. Obviously, there was a theory that the studio space was way undersupplied in most markets. Now there's quite a lot of supply coming, at least relative to the existing base. There's a theory that some of the Apples and Amazons and Netflixes of the world would have, they have so much cash. Gosh, they're just going to funnel it all into production. I think their stocks are down a little bit. And then the same thing, by the way, in life sciences, right? So life sciences, same exact thesis was not a ton of space relative to the demand, and so the demand was going to be infinite. Space needed to be built. There's now quite a bit of space being built, and those stocks are also down. And by the way, in companies that had never actually been profitable for the most part. That's not true of maybe Alexandria's portfolio, but in general. So just wanted to think through, what are the impacts? And by the way, if you wanted to take a non-niche asset class, we could talk about industrial, where Amazon had been purported or rumored, if you believe certain, sort of at least anecdotal evidence, to have taken up to a quarter of the take-up for industrial buildings that were above 500,000 or a million feet. The big bombers. Amazon appears to now be overweight. The logistics space, they're pulling back. So just what is the effect of all of those things on either the big asset class, if you want to go there, or on the niche sectors?
The effect of
Just the dynamic where the initial investment thesis was undersupplied,
right.
and with
Yeah.
a lot of tenant demand from really well capitalized companies.
Yeah.
And now what's happened is that there's probably there's at least been a lot of supply, right? And then the companies that are purported to be in demand have now faced some, they're facing some tailwinds.
Yeah.
Or headwinds.
We're hopeful because we have a value-add opportunistic fund where we anticipate some distress there because of exactly that. Like we don't play in the studio space, but I have seen
Hopeful that other people face distress so that you can
take
take
advantage of it. Exactly, situational distress or capital markets distress. But on the Amazon side, we've been always very cognizant of watching Amazon and not necessarily jumping in for that Amazon credit. And there is a saturation of Amazon credit. And actually the banks and investors actually penalize you for having more of that. So we've been very focused on making sure that we are diversified in our tenancy base and credit tenancy. So yes, but we'll have impact, which is why I said earlier that we're very focused on markets where there's really tight vacancy. And so if Amazon leaves the market, it's not a problem. So like the Inland Empire being one of them. And
0.4% vacancy
exactly.
in a 600 million square foot market.
Right.
Rents have been up, 12% annualized
Exactly.
for past decade, except for this year when they're up 60%?
yes, and that's been one of our biggest exposures in our fund. So so we're okay with that.
I'll hit life science and a little bit on industrial. Clearly, the secular story is very real for a whole lot of reasons in terms of computational power, what's happening in biology, what's happening with aging boomers, et cetera. There's a whole series of factors that make the continued growth of the life science business very rational. Like everything in our business, we can get overly exuberant about something and overbuild it, and it's probably always the thing that is probably the biggest impact on returns in our business over the years is excess supply. Boston, San Francisco, and San Diego are still the centers of the life science industry in this country. The economics of building a life science building are vastly better than building just about anything else. We spend an extra, in Boston, we probably spend an extra $150 a square foot in hard and soft costs, and we probably get $30 more in rent.
Wow.
That's kind of the math. So it's if your choice is to build Class A office and it's 12 stories or less versus life science, you're going to build life science. And we were probably about to get ahead of ourselves from a supply standpoint in Boston. I think what's going on in the equity markets is probably going to prevent a lot of that supply from happening. Which will be a really good thing for all. And the other thing I would just say about the life science business that is, there's two components to that business. There's the design and execution of building a life science building, which is a fairly technical building. But that's not really where the value is. The value in operating life science is understanding the tenancy and hoping, at least having a better idea about picking the winners and the losers and having a relationship with those tenants that chooses you over somebody else. And I equate it to, there's I don't know, under a half a dozen platform companies. We're in business with Alexandria. We've done a number of transactions where we've been partners with them. And I equate it to being in business, either you're an independent hotel, you're affiliated with one of the national chains. And we are absolutely seeing the benefits of that. And as I said, I think what's happening in the public markets is ultimately going to prevent a lot of that supply from happening. And that's a very good thing for the Boston market. In industrial, I'll only talk about what's happening in our market. I don't know it completely nationally, but there is still roughly a 10-to-1 relationship in Boston between demand and supply that's under construction right now. We're building less than 1% of our base in construction. So I do worry that ultimately, when when all of these companies solve their logistical network issues, this is not sustainable at these levels. You know, once Home Depot puts their 1 million square foot warehouse 25 miles outside of Boston, they're not going to do another one in 3 years. And so I think there's real pent-up demand still, and supply is not meeting that demand. But I wouldn't want to annualize our demand out 10 years and hope that developers don't build to that level.
You know, we tend to like businesses that have some sort of structural buoyancy outside local supply-demand characteristics. And in the case of our airport parking business, you know, it's been a great business on its own for us, but we also like owning scarce land around airports. And they don't move very often, and cities are growing, and so that land over time becomes more valuable. And in the last few years, we've sold several assets to industrial users at pretty good sized premiums to our reported fair values because the demand has gotten so high there. We still, despite the Amazon announcement and other things that we've seen, we still have interest from buyers who approach us, you know, regularly about these same kinds of deals. So we haven't seen the disruption there yet that might be coming. In fact, we didn't really, through the pandemic, we didn't see the disruption that we were expecting. We were, you know, when the pandemic happened, we're trying to look on the bright side. We're thinking there's going to be all this buy opportunity for us, and there was not at all in our spaces. So maybe it comes the next round with the recession, but not yet.
I think that I take this back to the Robin Hood phenomenon. So being a person that spent every day of their work career in the capital markets, and coming in as a rookie trader in 1982, which is the watershed year. When everybody talks about the watershed year, they say 1982. I had no idea what I was doing on the trading desk. Over the last 40 some odd years, though, I've learned a little bit. One of the things when I saw the Robin Hood phenomenon, Robin Hood, the free trading thing, and I remember sitting back looking at just how high it was flying, and I remember thinking, the business model of this brokerage entity is for people to come on and trade stock that know absolutely nothing about stock. They couldn't tell you what an EBITDA was, what EPS was, what a multiple was, what the company did that they were investing in. And that was their model. And these folks were going to continue to come on in this club-like manner and drive commissions through this platform so that they can lend out the shares and do those sorts of things. And I said, all that's going to work until, as Mike Tyson once said, everybody's got a plan until they get hit in the face.
Exactly.
Until these young 18, 16, and 20-year-olds playing with their allowance and their parents' money realize that money can go down 20, 30% in a day. You can actually lose money playing stock while you're trying to drive out short traders that have been doing this for 30, 40 years. You're smarter than them. And sure enough, we saw that happen. Robinhood came public at 37. I think it's at 10, 12 now, which I don't even know how it'd stand there. But when you look at what's going to happen in the marketplace, I've been down in Miami the last couple days looking at real estate because it's just been fascinating to me.
Yes.
I just had to see it for myself to see all my clients just going down there and Chicagoans going down there and just buying these
I thought
places.
they all went to Naples.
A lot of them went to Naples, Tampa, but Miami, and I went through and looked at developments for 2 days. All new, 6, 7, 8 million. I mean, $8 million rolls off the tongue like, a cup of coffee. And it's like, okay, how many people, at what point did all of this get started because overexuberance in the stock market made you look a lot richer than you actually were? And now you're down 30, 40%, and some of the stocks you point out are down 60, 70, 80%. At what time does that impact everything else that really got excited because of that? And so when you look at the industrial, when you look at residential, when you look at hotels, when you look at all that, that stock market exuberance and overvaluation drove an awful lot. And so, I'm just really curious to see what begins to happen, because there's no recovery in the stock market being forecast anytime soon for many of these companies that have come down 80%. They're not coming back. And so now what happens to young people that were working in these companies that had options that they thought were worth $25 million and bought a place in Miami or wherever? It'll be interesting to see what the ripple effect.
So on that
One, we
bullish, no, sorry.
Yes.
we saw that before the tech wreck too. But when
Yep.
everybody,
Yeah.
the first round of internet trading, when everybody, all these people I went to college with were quitting their jobs
Yeah.
out of the blue to be day traders, and they didn't know anything about trading or stocks or investing or anything, and that didn't last long.
So on that bullish note, let's go
I
to
said I
where-
started in '82. Remember?
Right, so
Todd,
it's been
I
a
would
bull
add
market
one
since
bullish
then.
component to that note, though, just before you move off the point,
Sure.
which is that real estate competes against private equity and venture among illiquid investment options. Through 12/31, real estate looked a lot less interesting than venture and private equity. And if you look at the major endowments and why they performed so well, it was because they had exposure to the right venture managers and the right private equity managers. And in fact, the difference over the last 10 years was almost 10 percentage points annualized between real estate performance and PE and venture performance. And today, many of those venture firms are probably going to see their most recent vintage funds off 50 to 75%. So I do think that the one good news about all of this is that I do think that real estate is going to look more appealing and more stable versus PE and venture for our allocations over the next few years.
We're going to look like the boring child, the boring steady Eddie child versus
I
the
think we
reckless
always
child.
have.
Yeah.
Right?
It's pretty much, some of us have no
We'll
choice.
take it. We'll take it.
Go ahead.
Just wanted to go to maybe where it all started, and maybe that's sort of the wrong entry point, but it would be a mistake, I think, for us to be on this panel and talk about the good fortune that we all have of making investment decisions at a time when there's now war in Europe, and without getting into the human costs, which are obviously very real and in ways that are incomprehensible probably to all of us in this room. Want to spend a second instead talking about what are the geopolitical impacts and how does that affect capital flows, how does that affect your investment decisions, how does that affect the supply chain. So just, let's talk about war and the effect, please.
I think on the margin, I think it helps the U.S. I mean, we're still the reserve currency. Disruption in Europe means capital should flow here. I think it helps all of our markets, probably including real estate.
I would say from an international investor perspective, we're seeing a tremendous amount of interest, and they're not wavered. And I would agree, they're even more so looking at us because of the impact in Europe. I would say from an investment perspective, there are certain asset classes that are tremendously benefiting from the supply chain or the onshoring, as people are saying. So I'll just give an example, like cold store trying to go internally, and there's obsolescence in general in that asset class. So the development of cold storage, and we're seeing a tremendous amount of volume in that, and we're participating in that.
I would say it depends on what China does. The Ukraine is a small country. If it was a direct conflict with Russia, that would be a different global matter altogether. If it's a direct conflict with China, that's a different situation altogether. That has global implications that can be catastrophic in either one of those. I would say with the Ukraine, in terms of the capital markets, we've clearly seen them impact some of the movement in yields in treasuries, but the impact coupled with inflation, you can't tell which is driving it. So I don't know if I could say that Ukraine thing, but I'd say what happens, particularly if China does get involved, I think then we're looking at something very different.
But Jim, don't you think that we're now, because we're worried about that we are doing more and more onshoring or partnering with different countries than we historically, with a less reliance on China?
There's no doubt about it.
Yeah.
And we're seeing some
We'll
of them
benefit
more interesting in partnering with us.
Right.
Particularly those around the Russian perimeter. And so it's an interesting situation, but I think what happens next, the things that happen next are what could be most interesting.
So turning that into capital flows discussion, historically, foreign investors have generally liked U.S. real estate, in particular groups that liked stable, core assets. It used to be office, by the way, long-term leases. I don't know that that's still as true. But obviously now that the dollar's reserve currency status has been solidified and there's been disruption elsewhere, and we have interest rate increases, the dollar is now much, much stronger. Hedging costs are much higher. Are you seeing that impact fund flows? And by the way, is that a bigger impact or a smaller impact than something completely different, which is the retail investor? $2.5 billion a month going into Blackstone. I don't know if it's $1 billion or so going into S-REIT for Starwood. I mean, which of those impacts is sustainable, and which of them is having a bigger impact in each of the sectors that you guys focus on?
All of our investors are domestic, so I would tell you that I mentioned we were closing our Fund 5, and it's almost entirely institutional investors, but we do have a handful of high net worth folks, and I would tell you the last 2 or 3 weeks, the allocation of dollars coming from those folks has probably fallen by 20% due to the sort of probably what's happened both to their public equity portfolio and how they think about illiquids in general, combined with the general feeling of unease and instability, and it just adds to this feeling of instability that we have across so many different segments right now.
I would say similar. However, the only thing that from the accredited investor perspective, on the retail side, I do think that everybody's seeing real estate as an inflation hedge, so you may see some inflows that way. But there's a lot of REITs that are focused on unaccredited investors, and I would be concerned there. But from the international investor perspective, I would say that they're still interested in office. So it's fascinating to me. They come in, they're not as wavered as we are, and their office hasn't been as impacted as our office has been. So for Class A specifically.
I'm glad we still have someone we can sell those to.
Exactly.
We're similar in that all of our investors are domestic, and we fortunately got a fundraise right before the pandemic. So we're not in capital raising mode right now, we're in investing mode, and the challenge for us has been competing with all this, everything we do is just awash in liquidity. So that's been the bigger challenge for us right now.
The theme, the concept is principal preservation and moderate growth. I see less swinging for the fences. We just rounded up for our JFK investment about $600 million of additional equity for that terminal after we got it all leased up with the international airlines and stable long-term air traffic's coming back. That was very, very attractive. We could have done a lot more than that because that looks solid. I think right now, what I would keep an eye on is really the impact of folks moving away from equities and risk on. And we've been risk on, full bores, full steam ahead, speculative for the last few years, to risk off just like that. And the type of investments that folks are going to be appreciating more, and principal preservation and much more moderate returns are really going to be the mantra going forward, I think.
So we're coming onto a time when we're going to ask for questions from the audience, and so I genuinely hope that there are questions from the audience. Before we do that, I just want rapid fire one last thing, which is, in the current environment, best investment idea. It's a secret, we won't tell. So best investment idea.
I'll talk my book, muni bonds. That shouldn't shock anybody.
I'm not going to give a specific prediction. I gave up predicting anything in 2016, but I would say look at the fundamentals. Look at demand sources, look at barriers to entry, look at great locations. I mean, buy good real estate right now. We're not going to get bailed out by interest rates anymore.
We still believe in ground-up industrial development.
I would say same.
Great. Thank you very much for the panel. Now I want to open it up to questions. Hopefully you guys can come up with some zingers that were better than what we already answered. But so please, yes.
Thank you for your comments. Rich Tucker here in Chicago. Jim, nice to see you. So one of the things, we're in the development business, and so I'm curious, as you're evaluating your own developments or you're underwriting your loans, we're sitting here saying, yes, interest rates are up, but tougher to develop, construction costs are up. probably barrier to entry becomes more important. How are you looking at 24, 36, 48 months out as you're underwriting exit cap rates compared to the same assets you were 6 months ago?
I'm happy to take this. We always underwrite cap rate expansion, and our team yells at us for that every single day. Like, why are we underwriting these? And we've been very disciplined. So we're continuing to underwrite either anywhere between, I think we had contracted a little bit. We were between 50 to 100 basis points wide, and now we're 100 to 150 basis points wide.
In what period?
A typical investment, so 3 to 5 years.
You know, we are going to require more margin to deal with that duration risk, number one. And number two, we're going to be focused on product types where we believe that there will be meaningful rent growth driven by scarcity. And there's certain products that fit into that category, and there's certain products that may not.
We're similar. We underwrite cap rate expansion. We price everything to a 10-year hold, but I have the same problem. Our team yells at us. Our CIO is sitting right over there. He's ready to yell at me now. But
And we're, Rich, you know us, we're kind of niche investors, and it depends on the situation, and our investors run the gamut to guys that can stay in forever or guys that want to come out. So it's very situational for us.
Makes it hard.
Yeah.
How do you feel about digital infrastructure, data centers? I didn't hear anything on that.
We just don't invest in the space, and it's not a major phenomenon in New England because of the cost of power. So I don't really have much to add there.
I think we've evaluated investing in it. It's just that it's such a bear of a cost, and if you get it wrong, you can get it really wrong. And now we're seeing just obsolescence just in the past 10 years of building data centers. And so for us, we're risk off.
You know, cities don't like them a lot. I think we're going to have one on our Michael Reese site because they don't create jobs, and they just take up land and they make a lot of noise. And so cities would rather see developments that employ people. And so maybe, I don't know, 3 or 4 or 5 guys can run a data center, just sit there. So we probably won't be big in those.
same with us. It's just not something we.
But I do think
take a
that there's
close look at.
interesting opportunities between, like, maybe it's not us not doing the data center specifically, but maybe it's the net lease of the fiber, or there's other types of digital real estate that you can, and there's a ton of innovation that's occurring. The only challenge for us is there's usually infra investors investing in that, and their cost of capital is just cheaper than ours.
Yeah.
We've looked at a couple of land sites where candidly what we did is we were looking at dilapidated retail centers or retail centers that weren't yet dilapidated, but it was coming. And in particular in Northern Virginia, where land for data centers has gone for, what used to be, $300,000, $500,000 an acre to now in some cases over $2 million an acre. And so the thought is if you applied those metrics to traditional retail real estate, you might be able to actually make sense of the numbers.
That's a good question.
Yeah.
I run investment sales for Meridian in New York City. We had a $240 million multifamily deal crater about 3 weeks ago. It was institutional capital with a local operator. The seller was wise enough to kind of adjust. He gave a de minimis adjustment, but we still couldn't hit the return hurdles for the capital investor. In times of disconnect like this, brokers like me, our Rolodex goes upside down. Todd's former partner when he was at Westbrook is a 22-time client. Westbrook's at the bottom of my list now, and it's private capital that's coming in, and families and people, generational owners. So for this deal, what happened was we pivoted, and by the grace of God, we got lucky, and it looks like we went hard on it just a day or two ago. But my question is for folks like you, when you have your core competencies, when it's infrastructure, when it's ground up and somewhat more diverse, do you ever adjust with your investors your returns? Do you ever say, look, our mandate is to be in San Francisco, New York, Chicago. Gone are the days that we can deliver a 2x or a high teens return. We still want to be there because it's our core competency, but Notre Dame, if you want to give us $500 million, we're looking at 13%. Do you go back to investors and say, we got to keep doing what we're doing, but we're not going to hit grand slams, we're going to do doubles and triples?
I'll say one just real quick. So you see LaGuardia now, which looks fine and is vibrant and active. But we won that deal just before the pandemic. And so it was an interesting discussion with our investors during that. And just before we went hard with our investors, we were awarded JFK, which is 4 times bigger than LaGuardia. And we were not closed with our fund yet. And so we actually had to have some very interesting discussions when you are developing an airport that's almost totally empty, which nobody has quite ever seen, an empty airport before. So we had those discussions. We're very fortunate to have some really long-term, forward-thinking clients that knew at some point we were going to get through this. Certainly we can do it faster. I just heard the United Airlines CEO on CNBC this morning saying that we're back to levels higher than 2019. So yeah, we actually have to do it. You just have to do it sometime.
And he needs pilots just in case real estate
Yeah,
brokerage
that's
is
right.
back that hard.
You know, the one thing I'd add to this question, you know, this was a real serious issue when the 10-year was 50 basis points or 100 basis points, and you know, our business is one that typically the preferred returns don't adjust as quickly as you know, the 10-year Treasury, and our return expectations don't adjust. Typically, our investors' return expectations don't adjust. Frankly, I think it's the opposite today. I mean, we can't go back to our investors in an environment where inflation is 6 to 8% and say we think you should accept lower yields. We think they're going to get paid higher yields than they should. And the challenge is that all of us own existing assets that were worth one thing on 12/31/21 and are worth something different today because the cost of capital has changed. But in fact, I think our investors looking forward are going to earn higher returns or going to demand higher returns than they have looking backwards, given how everything else is repriced.
Yeah, the only thing I would add is that our investors, especially at Artemis, are pension plans, and their constituencies are employees of the city and teachers. And you can't tell them that those teachers are not going to get the retirement that they anticipated. So, and we are very privileged to manage that capital. So we have to figure it out. So the answer is no.
Following up, how do you square that round peg where you want higher returns, but there's a wall of capital that has to be deployed, and something's got to give?
So I think one of the questions that we're all, you know, talking about is, you know, this sort of tension between the wall of capital. I don't know, what's the number? $450 billion of dry powder, if you believe the pre-Quinn numbers, and is that really the whole picture? Who knows? But the point is there's a lot of dry powder versus higher 10-year treasuries, risk-free rates, and how does that play out? And, you know, those are the two opposing forces. I don't know which way it goes, but I would tell you, you know, today, investors respond far more quickly and fill niches than we ever have before. You see a niche, and it's filled in a matter of months. So, you know, for example, if we come away from all of this and say, you know, we really should be buying existing apartment buildings or existing industrial buildings, the challenge with that is it's not that hard. And back to, you know, a wall of capital deciding to pursue the 2 or 3 things where we think there can actually be rent growth, and therefore the entry point goes up, and therefore the returns go down. That's what we all are going to have to continue to deal with going forward, and we're going to have to find those places where we think not everybody can do it. But those are the two opposing forces that we are going to contend with for the next few years.
Steve.
Western Europe has much lower cap rates than America. Why do we have a differential when we're a safer bet? You know, I wonder where we talk about increasing exit cap rates, whether that's actually going to continue to be true.
They were starting to converge, right, over the last year. And maybe, you know, I mean, we're right in the transition point right now. It is so hard to talk about much of anything with certainty. This all just started, I don't know, 60 days ago. And it is very possible that, you know, 6-9 months from now, given the wall of capital, given what you just said about European yields, that there's certain sectors where there's not a meaningful cap rate adjustment because we believe in rent growth and scarcity and all those other factors. I just think it's just too early to tell right now.
I would also just add that a lot of the European countries buy their own real estate. So their sovereigns, their pensions are actually the majority owner, like the Netherlands, for example, are the majority owner of their real estate. So they warrant a different cost and therefore trade a different yield. So it's a little bit, you have to keep that into consideration.
And very long-term holds over
Yeah,
there, too,
exactly,
so they
exactly.
can tolerate much lower
Right.
returns at any given time.
There's a question in the back. Tom.
Dude, last question in the back.
10 years ago at these conferences, you never heard anybody talk about industrial real estate. Nobody knew what it was. Same with life science. It's there, but it's a very, very, very small niche. My question to the panel is, what's going to happen to the billions and billions and billions of square feet of urban office building product in the next 3 to 10 years?
I know. I think I would just say that my concern is B and C versus A, and really that, and talking about ESG and the obsolescence of the building, have to get them up to ESG standards, especially in urban markets where, like in New York, we have all these regulations that are coming up. I don't have a crystal ball for you, but I do know it's an expensive asset class to carry, so I would be very concerned.
I think those buildings are going to have to compete on price, unfortunately, which is the worst thing you have to do. And over time, my guess is those valuations go to the point where the sellers are finally prepared to actually acknowledge what they're worth. There'll be trades that reflect the need to put massive amounts of capital into those buildings to make them competitive. So I think there's a giant repricing that's going to take many, many, many years to happen because no one's going to want to quite deal with it quickly.
And the demand is still very up in the air. I mean, the return to office and the remote working none of that has fully shaken out yet. I mean, we have days, we're on 3 days a week, but they're not assigned. So there are days that just randomly between travel and people not being there could be 5 people in our office. It's really, strange. And so we're having conversations about, do we really need the amount of office space that we used to have just to run our business?
One thing I'll say to close this out, I know you're trying to close it out, is I just don't believe this trend to the tertiary cities is going to continue.
Me either.
I just don't believe we're going to see all these people going to Colorado Springs, Deer Valley, Austin, Mumford, Tennessee. Name the city that just didn't really have much interest at all prior to the pandemic, now getting all of that. Also, I'll come back to the stock market. We've seen companies tolerate a lot of things when their stocks were, 70, 80% higher than where they are right now. And they could have you work from any place. I'll pay you anything. You work in Mumford, I'll pay you like you're in New York City. And by the way, you're 26 years old, you're on Zoom. Ted and I were just talking about it. I actually would rather have a 26-year-old in the office so that by the time they're 35-year-old, they really know what's going on in and around our firm.
Absolutely.
Versus they're really an excellent skier because they ski every afternoon because they live in Aspen. So I don't think cities are dead. I don't think they're dead.
So why don't we end on that note? And I guess the ultimate proof will be when 10 years from now at the conference, if there's still a picture of New York City or if it's an industrial building in the Inland Empire, we will then know who won the debate. I want to thank DLA again for hosting us. I want to thank all of our talented panelists. Thank you very much.